Tired of dealing with annoying flies, fruit flies, and gnats in your home? The Zevo Flying Insect Trap is your ultimate solution. Don't wait. Check out the link in the video description now to get your Zevo Flying Insect Trap on Amazon and enjoy a bug-free home today.
A top economist has issued a dire warning about the United States economy tearing into the Federal Reserve for what he called a policy blunder that could send the country into a recession. Mohamed El-Erian, the chief economic advisor at Allianz, said on Sunday that he fears for the first time in years that the economy may be heading into a recession following a dismal unemployment report. He places the blame on the Federal Reserve for keeping its main interest rate at a two-decade high since 2022 in its zeal to stifle inflation by making it more costly to borrow. Those hikes are now hitting the economy hard, he said, suggesting that the Fed should have lowered rates earlier. I really do worry that we may lose U.S. economic exceptionalism because of a policy mistake, he told Bloomberg TV on Sunday, as worldwide markets continued to plummet. Following the jobs report, which showed that unemployment in July rose to the highest level since October 2021, markets worldwide went into a tailspin amid fears that the U.S. economy is sputtering. A nearly 19% decline in Intel shares in aftermarket trading deepened the gloom. Economists at Goldman Sachs have since raised the likelihood of the U.S. slipping into a recession within the next year from 15% to 25%, while analysts at J.P. Morgan put the chances of a recession at 50%. To help save the economy, experts say the Federal Reserve must cut interest rates much more quickly than planned to avoid a huge recession. A rate cut would make it easier for U.S. households and companies to borrow money and boost the economy, but it could take months to a year for the full effects to filter through. The Goldman Sachs analysts said they expect the Fed will cut rates by 25 basis points, but noted that if the August employment report is as weak as July's was, they could opt for a larger cut. J.P. Morgan analysts, though, wrote in a memo that because the Fed looks to be materially behind the curve, we expect a 50 basis point cut at the September meeting, followed by another 50 basis point cut in November. Yet the Fed left benchmark borrowing costs unchanged at a 23-year high at its latest meeting last week. The market is now wondering if the Fed is too late in transitioning monetary policy, Quincy Crosby, chief global strategist at LPL Financial told CNBC. As the markets opened in Asia and Australia early Monday, Nasdaq futures dropped 2.27%, while SP 500 futures dropped 1.41%. The situation was not much better internationally, with Eurostoxx 50 futures down 0.6%, and Japan's Nikkei shedding a staggering 5.5% to hit a 7-month low, marking its biggest three-session loss since 2011. The losses followed the trend that began on Friday, when Japan's market retreated to where it was trading in January, before it surged to an all-time high last month of 42,000. Elsewhere in Asia on Friday, Hang Seng in Hong Kong dropped 2.1% to 16,945.51. While the Shanghai Composite Index saw a more modest loss, of 0.9% to 2,905.34. Chinese shares have extended losses as investors registered disappointment with the government's latest efforts to spur growth through various piecemeal measures, instead of hoped-for infusions of broader stimulus. The Kospi in Seoul dropped 3.7% to 2,676.19, and Taiwan's TAIEX sank 4.4%. Both markets tend to be hit hard by weakness in technology shares. Meanwhile, Australia's SPASX gave up 2.1% to 7,943.20, and the Sensex in India was down 1.1%. Bangkok SET fell 0.7%. Japanese shares also suffered after the central bank raised its benchmark interest rate on Wednesday to 0.25% from 0.1%. That pushed the value of the Japanese yen higher against the US dollar, potentially hurting overseas earnings of major manufacturers and deflating a boom in tourism. Investors now believe that other major central banks will follow the Fed's lead and ease rates more aggressively, with the European Central Bank believed to be cutting rates by 67 basis points by Christmas.